Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst at SSQ. We are pleased today to welcome Michele Robitaille, Managing Director at Guardian, here to talk to us about Guardian Equity Income Strategy. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the Q&A sections of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Michele, the floor is yours.
So we have a presentation in front of you that hopefully you guys can see on the screen, and I will just walk through that quickly, and then as you're told, we'll open it up for questions. Page 2 of the presentation is really just a snapshot of Guardian Capital. Hopefully you guys are all familiar with Guardian, since we have been on the platform for quite some time now. Really not a lot of changes here. Things keep moving along quite nicely. You can see there that we are a firm that is very much focused on managing assets for our clients. That's really the core of what we do here, with a number of different strategies, including equity strategies, fixed income, income-specific, such as this one, and some alternative strategies there. No new movements on the team that I work with, so myself and Kevin Hall and the analyst, our analyst Chung, who joined us last year. If we move to slide 3, this is a snapshot as of June 30th, and it just shows the performance of the fund. You can see, again, that this is the Guardian Equity Income Fund. It is a dividend-focused fund, and in order to achieve that high level of income, you can see that in terms of our investable universe, which is outlined under permitted securities. It talks about being the top 75% of Canadian dividend-paying equities. Today, that results in a dividend cut of about 1.5%, so you need to have a dividend over 1.5% to be eligible for this index. You can see also that our benchmark is the S&P/TSX Composite High Dividend Index, and again, we benchmark off that index because we feel that gives a better representation for what we're trying to achieve in the portfolio. The portfolio yield today is about 4.4%. And then you can see in terms of the performance metrics on the bottom, we show the equity income, which is the portfolio. We do show it against that equity income benchmark, which I discussed, the high dividend index, but we do also show the S&P/TSX Composite Total Return on the bottom there. Now, in terms of just a bit of a reminder in terms of our investment philosophy and process, just flipping forward one more page, our philosophy in terms of how we manage the funds is very much focused on total shareholder returns, but we really have 3 main tenets to our investment philosophy. So the first is that focus on dividends. We do believe that upfront yield is a very important component of total return. I talked about the 4.4%, which is the upfront yield on the fund. In addition to that, we would look to add somewhere in the range of 2 to 4% on an annual basis in capital gains. And we also like dividends because it reduces the volatility in the portfolio and in the results of the fund, and we can talk a little bit about the benefits of dividends in terms of dampening volatility and reducing the downside in portfolios. The second key tenet is a focus on fundamentals. So we're very much focused on underlying stock picking. That's if you look at the attribution or how we add value, going back over several years now, the way that we add value is by picking good companies. And so really what we're trying to do, and I'll talk a little bit more about our process, is to identify strong business franchises that can generate high levels of free cash flow and that have cash flow that can grow over time and that can continue to grow in various economic environments. So very much focused on those fundamentals. And then finally, our third investment tenet is that focus on risk management. So of course we have risk-controlled portfolios. We have risk management guidelines that we set out with SSQ, so we have those in terms of the fund, but we also implement risk management at every stage of the process. And so as we walk through our investment process here, what you'll see is that there is a big focus on risk management and making sure that only the right types of companies are getting into the portfolio. Slide 6, if we just flip forward for one page, is again just a snapshot of the equity income team. As I said, there are no changes to the team in terms of the people that have been managing your fund. Kevin Hall and myself are the co-managers on this fund. Kevin and I have been working together since 2002 on these equity income strategies, so for quite some time. And then we have an analyst, Chung Nguyen, who joined our team in March of last year. It's been a great addition. It's a very collaborative team effort. We work together very well. At Guardian, the model is that we are all generalist portfolio managers. So we all are very familiar with all parts of the portfolio, but then we have research priority coverage and idea generation. So basically what we do is we look at the universe and we divide it by industry sectors so that both Kevin and myself take about half of the universe for the purposes of prioritizing research coverage, generating ideas in the portfolio. We have formal weekly meetings that we sit down and discuss the portfolio, not only amongst our team, but we also have team meetings with our Canadian equity team, with our global teams at Guardian as well, talking about macro things. But in terms of the equity income team, we do meet weekly, but we also sit in offices right beside each other. In terms of making decisions and figuring out how things go in and out of the portfolio, we do both need to agree, so it's consensus decision-making by both of us before a name goes in. And then just on the bottom of the page, you can see a little snapshot of the Canadian equity team that we have at Guardian. As you can see, there's basically four pods, as we like to call them, or 4 products that we manage, and they each have a team of dedicated portfolio managers. But we do work closely with those teams because it is a relatively small universe in Canada, and there's a lot of synergies that go back and forth working together with them as well. In terms of our investment process, if I turn over to slide 7, what you can see is basically we have a 3-step investment process. It's a very disciplined approach. It's a combination of basically rigorous fundamental security analysis with a bit of a top-down perspective overlay on top. It's 3 steps to our process. So the first is, again, identifying that investable universe. And so what we do is a screen of the market. We are basically a Canadian-focused fund. We are an equity-focused fund. So we start off with the TSX Composite Index. And then what we do is a yield screen. So I talked about that 75% of the dividend yielding universe. So today a minimum yield of 1.5%. And then we also do a market capitalization screen. So basically you have to have a market cap of $1 billion or more in order to be eligible to fit into the portfolio. So that basically defines our investable universe. Then we move on to the second stage of the process, which is that bottom-up fundamental analysis. And this is really the core of the process. This is where we spend the bulk of our time. And what we do is we look at a number of qualitative and quantitative factors in order of analyzing the company. And as we go through those factors, we basically build conviction in the underlying name. We look at things like the operating market. We look at payout ratios, balance sheets. We look at the management team, a number of the underlying factors to make sure that we're comfortable. We look at the growth outlook of those companies, making sure that we're comfortable with all of the qualitative factors and quantitative factors that are driving the underlying company. And once we sort of do that and a company comes out and gets into our bullpen, we move into the third phase, which is portfolio construction. And portfolio construction is where we take those sort of best ideas and we put them into a portfolio for you. We do have very much a high-quality bias, but we also recognize that given the fact that we're in Canada, we have a couple of large dominant sectors here, sectors like energy, sectors like financials. And so because of that, we also do a bit of a top-down overlay. And so what I mean by that is that we'll develop a view on interest rates, we'll develop a view on commodity prices, particularly energy, oil versus gas, which parts of the market we like to be in better. We'll have a view on some of the regulatory overhangs or risks facing sectors like financials or telecom. And so those top-down overlays will come into deciding whether or not we want to be over or underweight those particular sectors. So that, in a nutshell, is our investment process. And maybe what I'll do is spend just a couple of minutes talking about or demonstrating, if we turn to slide 8, why it is that we'd like to focus on the dividend-paying part of the market. And so what you can see here, this is a pretty interesting slide. It goes back almost 30 years to December of 1986, and it's put together by, basically what it does is it looks at the TSX Composite Index, so the Canadian index, and what it does is it breaks down the members of the composite index into companies that either grow their dividends, pay dividends, just a straight composite as a whole, and companies that cut their dividends and don't pay dividends. And so what you can see on the first chart on the left-hand side under total annualized returns are basically that the TSX Composite is the broad-based index that's in the middle, that black line. And what you can see is that the companies that pay dividends, and even more importantly, companies that grow dividends, have better annualized returns than the broad-based market, and they certainly have better returns than companies that don't pay dividends at all and dividends that cut and companies that cut their dividends. So very, very strong return profile out of companies that pay their dividends. What you notice at the same time is if you move to the other side of the page under annualized volatility is not only do they have better returns, but they also have lower annualized volatility. And that's measured by standard deviation, but you can see again the composite index in the middle, which is a standard deviation in a given year. And what you can see again is that companies that can pay their dividends and companies, even more importantly, that can grow their dividends have lower standard deviation or lower volatility. So you're getting better return, you're getting lower volatility, both very attractive characteristics in the underlying portfolio. When we flip over to slide 9, what you can see is, again, a snapshot of the dividend-paying universe. And this is just a bit of a heat map, which hopefully gives you a bit of an idea of where we like to invest in the market. And so what this is on this page is basically a list of the names of all of the companies that are in the composite index that pay a dividend. So they're all listed there. And it's in order of declining yield. And the names that are highlighted in yellow are the names that we hold in our portfolio. So you can see, if you look at the third column, about 2/3 of the way down, there is a line there, and that's basically the line that marks the 75th percentile. And so basically we invest, our investable universe includes everything basically above that line. But what you can also see is that there's a really nice balance across sort of, or sweet spot in the portfolio of the yellow line, sort of the bottom half of the first column and the majority of the second column, with a fewer names in sort of that third column. And so really what you can see is that the sweet spot in the portfolio is companies that have about a 2.5 to 4 or 5% dividend range. We do have a couple of names right now in that have a little bit higher dividend yields. We generally don't have a lot of representation in the top 10 names in terms of the companies that pay the highest dividend yields, and that is very much by design. Generally, if you have a very high dividend yield, it is because the market perceives that there's a risk to the underlying dividend sustainability. Right now we do have a handful of names that are up there. We are paying very, very close attention to those names, and both in the case of AltaGas and Chemtrade. They have had some operational missteps, or in the case of AltaGas, they're undergoing a fairly big transformative acquisition, and so they're basically working there through that. We would expect that for both of those companies, that as they move through those operational challenges, that share price performance will improve and that the dividends will come down. But in the interim, we do remain very, very comfortable with the sustainability of the dividends on those names. Maybe just moving ahead to slide 10, this is again just a snapshot of the equity income portfolio, and it points to that concept of dividend growth. And so as I alluded to, it's companies, and we talked about on the earlier slides, it's companies that can actually grow their dividend, that have the best performance overall. And so this is just breaking down the portfolio as a percentage in terms of the number of names that have either increased their dividend, maintained their dividend, or decreased their dividend. And so what you can see, this is on average going back to 2012, generally somewhere in the range of 60 to 65% of our companies will increase their dividends. The pretty nice dividend increases there. About 30% of the companies, 30 to 35, will maintain their dividends or keep them constant. And then we have had a handful of companies that have cut their dividends. In 2015 and 16 in particular, the majority of the companies that cut their dividends were energy names, and so those were companies that cut their dividend in the face of very, very weak commodity price markets, oil markets, and natural gas markets. And again, in terms of our philosophy, if it is because of an extraneous factor that companies are cutting their dividends, so in this case because oil prices had collapsed, if we like the underlying company, we like the balance sheet, we like what the company is doing, then we will often continue to hold those companies through the dividend cut, and that's exactly what happened through 2015 and 2016 with those energy companies. But we do continue to think that there's good prospects for those companies, and I can talk about them a little bit more later. Turning over to slide 11 is a snapshot of the portfolio, and again, this is at June 30th, 2018. And you can see basically that we provide the industry sector at the top. You can see the weighting in the portfolio relative to the weighting in the benchmark. As consistent with prior years, energy does make up a big part of the portfolio, as does financials, and so maybe I'll just touch quickly on those two names. In terms of energy, what you can see is that there's two groupings. The top grouping, which includes names like Arc Energy and Canadian Natural Resources, those are the E&P companies, or the companies that are actually oil and gas producers, and so they are more exposed to the commodity pricing in the sector, more directly exposed because of their production. And currently, when you look at oil and gas or E&P producers, they comprise about 8% of the total portfolio. We consider them all to be very, very high-quality names. We think that they are all companies that have strong balance sheets. They have very, very strong asset bases that have the ability to, in the event oil prices were to collapse again, to manage well through that process. But we also think that they will benefit as we see some strength in oil prices, and I'll talk about our outlook on oil a little bit later. But when you look at the bottom half of that group, that energy grouping, those are the energy infrastructure names, and they in fact comprise a much bigger portion of our energy weighting. We're currently at about 18 or 19% in energy infrastructure, as you can see there, and they have much more stable earnings profiles, much more stable dividend profiles. Because they're dividends, a lot of them are actually rate regulated, which are very utility-like. They can tend to have very, very contracted earning streams, and so regardless of what energy prices are doing, these companies are able to earn basically the same level of earnings. They're able to maintain their dividends, in fact grow their dividends, and so we find it a very attractive part of the energy market to be in. I'll talk also just briefly on financials. You can see a breakdown of financials as well. So the top 4 names are the banks. Our weighting in banks today is about 18 to 19%. We are just slightly underweight. We do continue to like the banks as a group. They have faced some headwinds this year in the form of the slowing mortgage market, a lot of concern over the new B20 mortgage rules and what that was going to do. Thus far, it does look very much like there is going to be a soft landing scenario in terms of both the slowdown in mortgage growth and the housing market itself, which was basically what we had expected. And we do think that the banks are poised to have probably stronger performance as we move into the back end of the year here. That has been the pattern for the last number of years. Earnings have been quite strong, and we expect them to remain strong in the fourth quarter. Basically propelled by all parts of the business, and credit losses to this point remain very, very contained. We also have a fairly healthy weighting in non-financial or non-bank financials, so some insurance weighting in names like Manulife and Power Corp, also names like Intact, which is a property and casualty insurer, and then Thomson Reuters as well. What you can also see there is that we have been slightly underweight some of the more interest-sensitive sectors. So if you look at telecom, for example, you look at utilities, you look at real estate, we're slightly overweight, but the more interest-sensitive parts of the market, we have been slightly underweight, although we have been through the year increasing our weighting to those sectors because we do believe that this business cycle is going to come to an end at some point in the next little while, and so we're gradually moving a little bit more defensively, and I'll talk about that a little bit more later. So moving on to slide 12, which is our next slide, you can see the transactions that we've had on a year-to-date basis. In terms of this portfolio, it is a relatively low turnover portfolio, so we will generally add 2 or 3 or 4 names in a year and take out 3 or 4 names in a year on an ongoing basis. But what we will tend to do is trade around our core positions. So you can see some of the transactions for 2018. There was a transaction earlier this year. CREIT, which is the Canadian Real Estate Investment Trust, was subject to a takeover offer from Choice Properties, which is the Loblaws REIT, essentially. We did tender and get mostly cash for that offering, but then we did end up with a little bit of Choice units, which we subsequently sold out of the portfolio because we felt that the valuation was quite high there, and we felt that we had enough retail exposure within the portfolio, and so we moved that into the Fortis, which you see as the addition in the second quarter, just again slightly increasing that utilities weighting in the portfolio. And so maybe what I'll do now is just flip forward for another page or two, and I'll just talk a little bit about our capital markets and our economic outlook, and we can spend a little bit of time on that. And, you know, the capital markets, I would say, they've been pretty interesting, and I think you have to really separate sort of what's going on from a fundamental standpoint to sort of all the noise and uncertainty that is being caused out there. And so when we look at the actual markets themselves, you know, we think that the backdrop for Canadian equities actually remains quite constructive. We look at the health of the U.S. economy, the health of the Canadian economy. Both of them are in large part quite healthy. The U.S. market in particular, the economics continue to be quite robust. Consumers are in very, very good shape, and consumers generally tend to be supported by both strong job markets, and the job markets are very, very good, and by stable housing markets. And stable housing has also been a hallmark of the U.S. this year, and so that's very positive. In addition, we have a very strong and stable corporate sector, which has been helped by U.S. tax reform, which is providing a bit of a tailwind and some additional cash for these guys. And they are also causing them, or basically some of the rule changes are also incenting them to reinvest in the economy. So the U.S. economy is humming along quite nicely here. The Canadian economy a little bit less strong than the U.S. economy, but still trending along quite nicely. We slowed down a little bit
from last year, but that was expected because we were sort of above trend. And now I would say that the market in Canada continues to be quite stable, notwithstanding some of the uncertainties that are being caused by NAFTA, and I'll talk about that in a little bit too. We look at the rest of the world, we do have synchronized global growth, so most economies around the world continue to grow. It has been moderating somewhat, so you're starting to see some signs of slowing, and again, this brings us into our sort of more cautious stance. So outside of the U.S. in particular, you're seeing some signs of slowing. In particular, there's some headwinds in the last little while. With the strength of the U.S. dollar, you're seeing some tensions or some stresses in the emerging market economies, and so they are starting to struggle, and that is slowing things down. I think in China, there are some questions, particularly with the China-U.S. trade war, about whether or not it is going to slow down. They are starting to re-stimulate that economy as well. But so there are some signs of slowdown there. But in general, we have very positive earnings growth. Earnings growth in the U.S. remains very strong, and oil prices are remaining strong. So I would say despite the fact that global growth is slowing a little bit, in general, the backdrop remains very, very constructive. Now, that being said, there's an awful lot of noise in the market today, a lot of headline news, a lot of things that could, frankly, spook the market in a way that could cause a fairly significant correction. So we talked about NAFTA. NAFTA, I think, is causing a lot of uncertainty, particularly for Canadian companies. We do think that if we do not get a NAFTA deal, it would be quite negative for the Canadian markets, at least on an initial blush. I think the impact on the Canadian economy of no deal over time is certainly manageable. But I would say our base case at this point remains that we do get a deal. I think we can get quite a reasonable deal. I think that, you know, they are negotiating hard in there, but I think that at this point, because of the interrelatedness of the Canadian and U.S. economies, it is highly likely that they try and incorporate having Canada back into the NAFTA agreement and that we do come to some kind of resolution. The U.S.-China trade dispute, again, continues to heat up and causes a lot of risk, I would say, to the global growth outlook. I would say that, you know, tensions do continue to be heated. There is some speculation that China is really the main target of the U.S. administration, and they are sort of saber-rattling to Canada and Europe and a number of other countries on trade, but China is really sort of the key target. So it remains unclear as to what the end game is there. You are starting to see things escalate a little bit. If they continue to escalate, I think that would definitely be negative from a global growth standpoint, but we will continue to watch and wait and see. I think the reality is that if that continues to escalate, it will be negative for all players involved. I don't think there are any clear winners. I don't think that the U.S., despite some of the comments out of Trump, is a winner from a trade war with China, and so hopefully they can sort that out. Other things all over the world, we have some geopolitical issues, Iran in particular, heating up a little bit with the sanctions coming into force in November. Brexit also continues to be very, very messy, very unclear about what's happening there. Some other tensions in Europe, like Italy. North Korea has settled down for now, but could obviously spark up again. And then we have sort of questions around the sustainability of oil price, direction of interest rates and things. So a lot of headwinds out there. And so I would say because of that, we like the fact that our portfolio is generally defensive by nature. It is a dividend-oriented portfolio, which tends to have a little bit more downside protection. But I would say that we are, I would say, neutral to shifting towards negative in terms of the tilt in the portfolio and being more and more defensive. So turning over to slide 15 and talking again a little bit more about our positioning. So we do expect that the continued strength in the U.S. economy is going to continue. When we look at rates, the Bank of Canada did raise rates in July for the second time this year. Given the deceleration that we've seen in Canadian GDP from the second quarter in 2017, the uncertainties that have been caused in the Canadian housing market from the most recent B20 mortgage rules and rising trade tensions, we do think that the BOC is likely to, or the Bank of Canada, pardon me, is likely to be quite patient before its next tightening. Now, that being said, there is quite a bit of speculation that they could go once more this year. I would say that the data have strengthened a little bit. We had quite weak, Q2 data. It strengthened a little bit. So I think it is reasonable to think that the Bank of Canada could go in October, but you know, I think it's equally likely that they probably hold off a little bit to wait and see what shakes out in terms of the NAFTA negotiations here over the next month or so before, and so they're likely waiting to see how that plays out. In the event that they do go, I would say that our review of interest rates in Canada is that there is likely one, possibly two more rate increases out of the Bank of Canada before we sort of have to stand pat, and then it will be quite a long time before you see any sort of move, or if you do see a move, it will be a downward move in interest rates, given where we are in the economic cycle, and I have a good slide on that as well. In the U.S., we do expect that the Federal Reserve will continue to hike rates in 2018, so we will likely see two more rate hikes out of them. But then we do, again, continue to think that you're going to see a measured and gradual approach to tightening. We do think that they will continue to unwind their quantitative easing program, further reduce the balance sheet, but as long as the U.S. economy continues to hum along and the data are supportive, I would say that we would expect to see rates continue to increase. I think you could see a couple of further increases as we move through 2019. So a little bit ahead of where we expect Canadian interest rates to go in the U.S. But again, given where we are in the business cycle, I think that by the end of 2019, for certain, we will be very much at the end of this tightening cycle. So again, and I've alluded to this a few times, you know, we do think we're very much in the late stages of this business cycle. It's very hard at this point to say, you know, whether or not this business cycle is going to wind down in 6 months or 12 months or 18 months. There's a number of factors that are extending it, a number of factors that are causing it to move forward a little bit. But we do think that it's a time for investors to give more consideration to downside protection in their portfolios. We've had very strong upward moves in the markets for the last number of years, but we do think that it is time to become a little bit more conservative, and that is generally the tilt that we are taking in our portfolio and will continue to take as we move through the back end of this year. We continue to think that dividends will be a strong contributor to total returns in 2018 and will also provide that good downside protection should the equity markets get pulled down by some of the macro events that we've talked about. So that's sort of our general macro view, and I think if we turn over the slide to slide 16, this is really an interesting slide. It basically just talks about where we are in terms of interest rates, in terms of the economic cycle. You can see basically, you know, after coming out of the Great Recession in 2008 and 2009, we've basically gone through an early recovery, had a little bit of slowdown. We're very much in that late recovery cycle. You can see that rates have been rising, momentum has been increasing, but as we continue to move towards the top end of that business cycle, we expect that we'll come back into, and it's unclear whether or not we'll go into a recession, but we'll certainly go into a slowdown in terms of the economy and in terms of what's happening, and in which case, you know, the income style, the defensive styles will come back into favor, and we do anticipate that by the end of 2019, we will be looking at interest rates coming down again as opposed to continuing to move up. When we look at moving forward on slide, the equity valuations in the market, I would say the top chart here is the TSX, which is the Canadian market. You can see here, it's a little bit hard to see, but we're currently trading at about a 14.8 multiple, or just under 15 times. The long-term average, which is in the top corner of the chart, is just over 15 times. We're basically trading a little bit lower than the long-term average in the market. Not particularly expensive, the Canadian market. There's certainly decent opportunities that we're finding here, although they do tend to be sort of name-specific. Not the same situation when we look at the U.S. market. The U.S. market is on the bottom there, the S&P 500 PE multiple. You can see that the multiple there is 16 times in terms of the PE multiple on the market. And when we look up at the top corner again, you can see the median multiple is about 14.4, or the average is 14.3. So the U.S. market continues to be quite expensive. It also continues to be quite variable in terms of where you're seeing earnings growth and what's going on there. We do expect to see earnings growth starting to slow down as we move into the back half of 2018 and into 2019, but we do expect it will continue to be strong for at least the next sort of 6 to 9 months. In terms of valuations, but generally because markets are forward-looking, as we see that turnover or rollover in earnings growth, we think that the market will sit up and take notice about where we are. Turning over to slide 18, I might just touch a few minutes on the oil market outlook, and then I will close things off here for us. But in terms of oil market, I would say that oil prices continue to reflect a pretty strong improvement in underlying fundamentals. We have a very much improved supply and demand balance. Global demand growth has been very, very strong, and notwithstanding sort of the concerns that we're seeing about global growth, global demand continues to be quite strong here, and we expect that it will continue to be strong even if we get a little bit of a turnover because of things like the transportation initiatives that you're seeing in China, in India, and the increase for crude oil in the developing world. When we look at OPEC and non-OPEC supply cuts and the dramatic decline that we've seen in oil production from places like Venezuela, they've more than offset the impact of U.S. production growth. So we are seeing some growth in the U.S. basin, which has been quite positive, but there is enough supply coming off from countries outside of Canada that it's been more than offset. So we're not seeing a lot of new supply come on. Oil inventories are declining, and again, that's a sign that supply has actually been below demand, and so you're starting to see those inventories draw down, and we're now actually below the 5-year average in terms of inventories. And OPEC continues to basically be quite compliant with the production cuts. I think there's frankly a very real question about how much excess supply or how much extra production OPEC could actually bring on at this point, and certainly whether or not it's enough to offset the supply cuts that we're seeing out of Venezuela, and once we get these Iranian sanctions in, whether or not that will be. So we do expect that the trend in oil prices will be will continue to be quite strong. Pricing will be quite supportive. The risk, I would say, to the upside. And when you look at sort of the geopolitical risks out there, you know, the geopolitical situation continues to get more tense. Again, countries like Iran, countries like Venezuela I've talked about, but even in countries like Yemen and Libya, which continues to have uprisings. In terms of Canadian producers, we have benefited a little bit less from the strength that we've seen in WTI oil pricing, and that is because of where we are. We are unfortunately at the wrong end of this pipeline. Heavy oil differentials have remained quite volatile. They did improve through the second quarter, but they've widened out again in the last number of weeks and are quite wide. The offset to that has been that we have had a very weak Canadian dollar, and so I would say that crude pricing realizations for Canadian producers have been quite strong, but there's clearly some concern in the market with these wide differentials and how long they're going to last. We do think that crude by rail volume is going to ramp up here in Q3 and Q4. We're starting to see that now, and that should continue to ramp up into 2019. But we continue to have a situation where there is just not enough takeaway capacity, and so we continue to expect that you'll see some volatility through 2018 and into 2019. But that being said, when you look at sort of where differentials are trending, offset by the weak Canadian dollar, you know, we do think that energy equities today are very inexpensive. They're certainly not pricing in the current oil price environment, and we do think that as these companies continue to generate very strong cash flows and continue to manage their balance sheets very well, that you will start to see a return of investor interest to the oil patch. And again, I have some charts here, which I won't spend a lot of time on, but you can flip through, which basically looks at the weekly U.S. field production. You can see, again, that we talked about U.S. production increasing quite nicely, but again, not enough to offset the supply declines that we've seen from the rest of the world. So you can see that the U.S. has added on a sort of year-to-date basis. They're up probably 600,000 or 700,000 barrels, which is quite good, but not nearly enough to offset the cuts in supply that we're seeing from countries like Venezuela. And then finally, I'll just touch quickly on the OECD and crude oil inventories, which I talked about. These are just, again, some snapshots so you can see that oil inventories are coming down not only in the U.S., but around the world. And that concludes my formal remarks. And maybe what I'll do is turn it back to the moderator and see if anyone has any questions or where we are in terms of time.
Okay, thank you, Michele. So like you mentioned, we'll now proceed to answer some of your questions. First question we received, could you talk to us about how the recent increases in interest rate affect the strategy?
Absolutely. And so I would say that, you know, the increase in interest rates has been something that we have been preparing for quite some time. I would say in general, we tend to focus on companies that are not only maintaining their dividends, but are growing their dividends. So there is a focus on growth in the underlying portfolio. You noted that about 65% of our companies increase their dividends, and part of the reason for that is because if you get into an interest rate environment where rates are going up, even by sort of 25 or 50 basis points, most of these companies have more than strong enough dividend growth to offset that dividend or the interest rate increase. As long as interest rates are increasing because the economy is strong and the outlook is good, companies that have pricing power have the ability to price through or the interest rate increases, and it tends to result in stronger earnings. And so that's, I would say, the first thing. The second thing is that we talked a little bit about the fact that we have been a little bit underweight some of those interest-sensitive sectors. So I touched on things like telecom and utilities, energy infrastructure, also have been quite underweight all of those sectors because of the interest rate sensitivity. As we move into what we consider to be the end of the business cycle, we will be gradually increasing our weights in those sectors in anticipation that, again, this hiking cycle in interest rates is likely going to come to an end in the next sort of 6 to 9 months.
Okay, and last question. What is the reason for the performance of value stocks in recent years, given that dividend payers usually outperform the TSX composite index?
Yeah, I mean, and it has been interesting. If you go back over the last couple of years, there's been a very clear trend of dividend stocks underperforming the broad-based market. And that's true not only in Canada, but in fact around the world. And so really the primary reasons that we can look at and point to are the fact that, particularly in the U.S., if we look at sort of the performance of the markets, markets have been on basically a very extended one-way upward trajectory for quite some time. And in 2016 and 2017 in particular, the volatility in the market was very, very low. So despite the fact that we had a lot of macro risks out there, the markets really shrugged them off. So you didn't see a lot of volatility. We have some great charts that look at the volatility in 2017 and 2016, and it is at all-time lows, very, very low relative to the rest of the market. And so it created this sense of complacency where people wanted to participate in the upside of the market. They were less concerned about the downside because there was no volatility, so they weren't being reminded of the risk of the downside correction in the market. And so you had basically this growth and momentum shift into the growthier parts of the market. So effectively what we would call a very strong and sustained risk-on market. What you started to see over the last couple of months in particular is that dividend stocks are coming back into favor. And so if we look at our performance, frankly, even since the end of June, we've made up quite a bit of ground with dividend stocks starting to come back into favor. It is a trend that we think will continue to reverse itself as we see more volatility in the market. The volatility, I think if we did this analysis, I think in sort of the middle of February, and there was a higher number of days with 1% swings up or down in the first 6 weeks of this year than there was in the entire year of 2017. So volatility is here, it's continuing, and we think that that is going to push some of the trend towards those more dividend-oriented stocks in conjunction with the fact that we think that as we move towards the end of the interest rate hiking cycle, people will become a lot less concerned about, interest rate headwinds and a lot more concerned about that downside protection in the portfolio.
Okay, great. Well, thank you very much, Michele. Really interesting presentation. So there are no more questions right now, so this would conclude the presentation. To all of you who have listened to the webinar, thank you for your participation, and come back in October as SEC Worldwide will present to us their international equity strategy. So thank you, everybody. Have a great day.